Brad Williams, Frugal Finance, the Bank Immunization Case. Assume that a bank holds a $100 million liability portfolio in Bond B, the composition of which is fixed. The bank wishes to hold an asset portfolio on bonds A and C that will protect the wealth position of the bank from any changes as a result of a change in yields. 5 different portfolio combinations illustrate different means to achieve the desired results. For bond portfolio 1, hold bond A and C, the traditional approach. Bond portfolio 2, hold bond C, sell T-bill futures. Bond portfolio 3, hold bond A, buy T-bond futures. Bond portfolio 4, hold bond A, buy T-bill futures. Bond portfolio 5, hold bond C, buy T-bond futures. For each portfolio in table 6.26, the full $100 million is put in a bond portfolio and is balanced out by cash. Bond portfolio 1 exemplifies the traditional approach of immunizing by holding only bonds. Bond portfolio 2 and 5 are composed of bond C and a short futures position. By contrast, the low volatility bond A is held in bond portfolios 3 and 4. In conjunction with bond A, the overall interest rate sensitivity is increased by buying interest rate futures. Now assume an instantaneous drop in rates from 12 to 11% for all maturities. Table 6.27 shows the effect on the portfolios as the rows that report wealth change reveal all 5 methods perform similarly. The tiny changes stem from rounding errors and this discrete change in interest rates. One important concern in the implementation of immunization strategies is the transaction cost involved. If immunizing commission charges, marketability, and liquidity of the bond portfolio becomes increasingly vital, interest rate futures play a critical role in managing bond portfolios because of their practical benefits. To explain, let's review the transaction costs linked with various immunization portfolios during the planning period. Starting from the initial position of $100 million in bond C and wishing to shorten the duration to 6 years, table 6.28 shows the trades necessary and the estimated cost involved. To implement the bonds-only traditional approach of bond portfolio 1, one must sell 125,476 bonds of type C and buy 64,387 bonds of type A. Assuming a commission charge of $5 per bond, total commission is $949,315. By contrast, one could sell 1,355 T-bill future contracts to immunize bond portfolio 2 or sell 662 T-bond future contracts for bond portfolio 3 at a total cost of $27,113,240 respectively. Additionally, one would have to deposit approximately $2 million margin for the T-bill strategy or $1 million for the T-bond strategy. But this margin deposit can be in the form of interest earning assets. Table 6.2 presents these transactions and the costs. Original $100 million, new portfolio value 106, total wealth change. We're going to see this variation here, gain, losses, etc. Go ahead and read through this. Then we have transaction cost. So you can see total cost $949, $27,1, $13,4. Clearly, there's a tremendous difference in transaction costs between trading the cash and futures instruments. In an extreme example of this type, the transaction cost for the bonds only cause, in an extreme example of this type, the transaction cost for the bonds only case is prohibitive, amounting to almost 1% of the total portfolio value. It is practically impossible for another reason. The volume of bonds to be traded is enormous, exceeding any reasonable volume for bonds or even the largest issue. By contrast, today's robust futures volume makes it easy to implement the futures-based immunization strategy. Until recently, immunization strategies for bond portfolios have focused on all bond portfolios. Here, it has been shown that interest rate futures can be used in conjunction with bond portfolios to provide the same kind of immunization. The method advocated here works equally well for planning period case and the bank immunization case. Note that all the examples assume parallel shifting yield curves. If the change in interest rates brings about non-parallel moves in the yield curve, then the bonds with future methods will generate different outcomes. The winning method will depend on the movement of interest rate changes that actually occur. Read it if you need it. Brad Williams, Frugal Finance. Thanks for watching.